It was a Tuesday morning in April 1981 when the loan officer from First National drove out to Earl Hendricks' place in central Iowa. He didn't call ahead. That's how it worked back then, a handshake industry, relationships built on county roads and kitchen tables. Earl set out 2 cups of coffee and listened while the man laid out the numbers. Corn was at $3.10 a bushel. Land in the county was trading at $2,200 an acre, nearly double what it had been 5 years prior. The bank had capital. The bank liked Earl's operation, and the bank was prepared to extend his credit line by $180,000, enough to pick up the 160-acre parcel on the county line that had just come available, modernize his equipment, and run a larger operation heading into what most people believed was a golden decade for American agriculture. Earl listened. He asked 2 questions about the interest terms. He nodded slowly at the answers. And then he said no, not dramatically, not with a speech. He just said he wasn't looking to expand right now, thanked the man for the drive out, and refilled the coffee. The loan officer left puzzled. In April of 1981, turning down a bank's offer to help you grow felt less like caution and more like confusion. In 1981, expansion felt like survival. Every neighbor was doing it. Every conversation at the co-op ended with someone talking about acres picked up, equipment upgraded, ground leased through the next season. The logic was not irrational. When land appreciates faster than inflation and commodity prices are strong, leverage looks like a tool rather than a trap. Earl understood this. He had farmed long enough to understand the arithmetic of boom years. He also understood something the loan officer's spreadsheet didn't account for: the arithmetic of what happens when boom years end. He had $340,000 in existing debt across his operation: land note, equipment, operating line. The interest rate on his primary note was sitting at 14.5%, adjustable. Prime rate had been climbing for 2 years running. When Earl did the quiet math in his head that April morning, what he saw was not an opportunity. What he saw was exposure. More land meant more principal. More principal at variable rates meant higher monthly fixed costs. Fixed costs don't negotiate. They don't soften when the market shifts. They arrive on the same date every month, regardless of what corn is doing. He chose to pay down $40,000 of principal that spring instead. By that summer, the decision looked wrong. The Metzler operation 2 miles north had taken on the financing. They picked up 240 acres, leased another 180, and were running close to 800 acres total. Their equipment was new. Their bin capacity had doubled. When corn came in at $3.20 that fall and land values held firm, the Metzlers were pulling ahead in every visible way. Earl was farming the same ground he'd farmed for 11 years. His equipment was aging. His operation looked from the road like a man standing still. When prices are high, caution looks like fear. There were conversations at church, at the elevator, quiet ones where people weren't exactly cruel, but weren't exactly kind either. Someone mentioned that Earl had passed on the county line parcel and that the Millers had picked it up instead and were already planning improvements. Someone else noted that the bank had been generous this year and that the men who moved were going to be in a different position in 5 years. Earl didn't argue. He came home, sat at the same kitchen table, and looked at his reduced debt schedule. He still owed too much. He paid down another $18,000 in December. In early 1982, 2 things happened almost simultaneously. The first was that corn prices began to soften. Not collapse, soften. $3.10 became $2.90, then $2.70 by spring. It was the kind of decline that feels temporary when you're inside it. The men who had expanded looked at their projections and recalculated. They had modeled for $3 corn. At $2.70, margins compressed but didn't disappear. They adjusted. They expected a recovery. The second thing was that the Federal Reserve's extended tightening cycle was working its way through every variable rate instrument in American agriculture. Prime rate hit 21.5% in June of 1981 and had remained elevated. By mid-1982, farms carrying adjustable rate debt were seeing interest expense climb to levels that had not existed in their original projections. A $400,000 note at 14% required $56,000 in annual interest. The same note, repriced at 18%, required $72,000. On an operation with $180,000 in gross margin, that difference was not a rounding error. That difference was everything. Debt doesn't shout, it waits. And then it compounds. Earl watched his neighbor's operations with the attention of someone who knew what he was looking at. He could see it in small things. The Metzlers ran their equipment harder and maintained it less. The Millers skipped the county drainage tile project they'd been planning for 3 years. Not enough cash flow. A man named Dale Sorensen, who had leased 400 acres on 3-year agreements signed in 1981 when land was worth leasing at $180 per acre, was now farming ground that required $72,000 in annual lease payments against corn that was pricing down toward $2.50. Lease obligations don't have bad years. They're fixed. They come due whether the crop does or not. Dale's operation was not broken yet, but it was fragile in a way that hadn't existed 18 months earlier. Growth had increased his exposure faster than it had increased his income. Earl, by contrast, had spent 1981 and early 1982 reducing his principal balance by nearly $62,000. His fixed annual debt service had dropped by roughly $9,000. That number sounds small in the context of a farm crisis. It was not small. In a year where margins were being compressed from every direction, price, input cost, interest, $9,000 in reduced fixed obligation was the difference between a farm that had options and a farm that did not. He had one other advantage that nobody discussed, but that turned out to matter enormously: liquidity. He had kept a cash reserve that his neighbors had deployed into expansion. That reserve didn't earn much. It sat in a savings account and drew modest interest. But it meant that when his operating line came up for renewal in the spring of 1982, he had the balance sheet to negotiate from a position of strength rather than necessity. Banks respond differently to borrowers who need them versus borrowers who don't. By the fall of 1982, the first serious signs of systemic stress were visible in the county. A banker at the local branch mentioned to Earl, carefully, without naming names, that several renewal applications were creating documentation challenges. That was banker language. It meant that farms that had expanded on projections built around 3.10 corn and 14% interest were now presenting cash flow statements that didn't support the debt load they were carrying. The first foreclosure notice in the county appeared in the legal section of the local paper in March of 1983. It was a farm north of town, not someone Earl knew well, but someone people knew. The sale was set for late spring. People talked about it with the mixture of sympathy and distance that communities produce when something terrible happens to a neighbor. The consensus was that it was an isolated case, a particular set of circumstances, not a pattern. Earl had been a farmer long enough to distrust that kind of consensus. He paid down another $25,000 in principal in the first half of 1983. People thought he was being excessive. Maybe he was. But his fixed costs kept falling, and what he noticed, watching the county, was that the farms with the highest fixed costs were the ones losing options fastest. They couldn't plant fewer acres. They couldn't reduce equipment overhead. They couldn't delay the lease payment. Every decision tree had been pruned down to a single branch by the weight of obligations entered when the world looked different. I've seen more farms fall from growth than from drought. That is not a metaphor. Drought is unpredictable. Nobody accuses a farmer of poor judgment for losing a crop to weather. But the farms that failed in this period did not fail because of drought. They failed because they had structured their operations around assumptions about price and interest that proved wrong, and because their fixed costs were too high to survive the correction. The structural difference between a farm that survived and a farm that didn't often came down to one decision made between 1979 and 1982: whether to expand aggressively or whether to stay cautious. The farms that expanded were not foolish. They were responding rationally to the information available at the time. Land was appreciating, commodity prices were strong, banks were willing to lend. In that environment, caution required you to hold a view that most of your peers, your bank, and your agricultural extension office would have told you was overcautious. Earl held that view anyway. He couldn't have told you precisely why. He would have said he just didn't feel comfortable with the debt load, that the interest terms felt uncertain to him, that he'd rather own what he had clearly than own more of it shakily. By 1984, the crisis was no longer isolated cases. Corn had dropped below $2.50 and was pushing toward $2 in some contract periods. Land values in Iowa had begun a decline that would take them from $2,200 per acre in 1981 to under $800 per acre by 1986, a drop of more than 60%. Farms that had borrowed against appraised land value as collateral were now carrying debt in excess of the collateral's worth. Banks that had extended credit on the assumption that land was a safe, appreciating asset were looking at their loan portfolios with serious concern. The foreclosure notices in the county paper were no longer isolated. They ran on the same page every week. Some of them were farms Earl had known his whole life, second-generation operations, men who had farmed their father's ground and who had believed reasonably that the 1970s momentum would continue. Earl attended one auction. He stood at the back and watched a neighbor's equipment roll across the block, machinery that had been new 3 years earlier, financed in 1981 on the assumption that scale would service the debt. It didn't sell for what it cost. It never does. Equipment depreciates. Land, it turned out, could too. He drove home and sat at the kitchen table for a long time. What he felt was not satisfaction. Survival is not satisfying when the people failing around you are people you respect. What he felt, more than anything, was clarity, a quiet, uncomfortable understanding of what had happened and why. He had been lucky in some respects. He had also made a specific choice that most of his neighbors had not made. That distinction mattered, and he didn't know exactly how to hold it. The structural math was becoming visible to anyone who wanted to look at it honestly. An operation that had expanded in 1981 and was now carrying $600,000 in total debt at interest rates between 16 and 19%, was paying somewhere between $96,000 and $114,000 per year in interest before touching principal. On corn at $2.10 a bushel, farming 800 acres at a yield of 130 bushels per acre, generated gross revenue of roughly $218,000. After seed, fertilizer, fuel, and labor, call it $145 per acre in variable costs, you were left with $58,000 in gross margin before debt service. Against $100,000 in annual interest, that farm was losing ground every single month. Not because it was badly managed, because the fixed cost structure had been built for a world that no longer existed. Earl's operation, by 1984, carried approximately $190,000 in total debt, down from $340,000 in 1981 through consistent principal reduction. His interest expense at then-current rates was roughly $30,000 annually. Farming 450 acres, he was generating enough gross margin to cover his debt service and maintain a modest cash position. He was not prospering. But he had options. Boom hides weakness. The weakness doesn't disappear, it waits for the conditions that reveal it. In 1985, the second wave of foreclosures moved through the county. This one reached farms that had survived 1983 and 1984 by negotiating extensions, drawing down reserves, or receiving informal accommodations from local bankers who were themselves under pressure from regulators. The accommodations ran out. The extensions expired. The reserves were gone. Land was selling at distressed prices. In some sections of the county, parcels were moving at $700 and $750 per acre, ground that had appraised at $2,000 4 years earlier. The men who were selling were not selling because they wanted to. They were selling because banks were calling notes and there was no refinancing available at any terms that worked. Earl had $85,000 in liquid reserves. He had spent 4 years reducing his fixed cost structure and maintaining cash while everyone around him had deployed capital into expansion. He bought 80 acres in the fall of 1985 at $780 per acre. He paid cash. He bought another 120 acres in early 1986 at $710 per acre. He financed $60,000 of it at a fixed rate. The environment had shifted, and fixed rates were now available at terms that were manageable. He knew what manageable meant. He had spent 5 years learning it from the other direction. There is a particular kind of arithmetic that only becomes visible in retrospect, and it is this. In 1981, Earl had owned 450 acres and carried $340,000 in debt. In 1987, Earl owned 650 acres and carried $220,000 in debt. He owned 44% more land. He owed 35% less money. His fixed cost structure was lower than it had been before the crisis began. His neighbors, who had expanded, those who had kept their farms, owned more acres than Earl, but carried debt loads that would take them decades to work through, on land that had been revalued at a fraction of what they'd paid. The men who had looked cautious in 1981 and 1982 ended up, in many cases, in a structurally stronger position than the men who had moved aggressively. Not because caution is always correct, not because growth is always wrong, but because in that particular moment, in that particular credit environment, growth increased exposure in ways that were not survivable when the assumptions behind the growth proved wrong. Earl never gave speeches about this. He didn't write letters to the extension office or show up at county meetings to explain what had happened. He farmed his ground and paid his notes and watched his debt schedule come down. If you asked him in the late 1980s what he would tell a younger farmer facing the same kind of decision, he would have said something like, "Know your fixed costs before you accept new obligations. Understand what your operation requires to survive a bad year, not just what it can achieve in a good one. And pay attention to interest rate trends in ways that most people find boring, because boring is where the compounding happens." He would not have said he was smarter than his neighbors. He watched people he respected lose ground they had worked their whole lives to build. That is not a story about intelligence or virtue. It is a story about structure, about the way debt load and fixed costs determine the options available to you when the environment shifts. Liquidity buys time. Time lets you wait. Waiting lets you buy at the bottom rather than sell into it. I think about this story a lot when I look at modern agricultural balance sheets. The specific numbers are different, the commodities are different, the interest rate environment is different. But the underlying dynamic, the way boom periods invite leverage, the way growth increases exposure, the way fixed costs become rigid just when you need flexibility, that dynamic does not change. The bank in 1981 was not malicious. The loan officer who drove out to Earl's kitchen table was doing his job in good faith, offering a product that made sense in the conditions that existed. The farmers who accepted were not reckless. They were responding rationally to the available signals. What Earl had was not superior information. He had a particular kind of discomfort with variable rate exposure at a moment when rates had been climbing for 2 years. He had a preference for reducing existing obligations over adding new ones. And he had perhaps a temperament that allowed him to hold a cautious position, even when holding it made him look like the least successful man at the elevator. That temperament, as it turned out, was the difference between owning the county line parcel by 1986 and watching it go across the auction block. If there is a lesson here, and I am careful about that word, because lessons extracted too cleanly from complicated histories tend to lose the weight that makes them true, it is something like this. The structure of your obligations determines your options. Options are what separate farms that survive, transitions from farms that don't. The cost of maintaining options is that you sometimes look wrong while the boom is running. You will watch people do more than you and gain more than you and, for a period, be more successful than you by every visible measure. And then the transition comes. They always come. Corn at $3.10 does not last forever. Interest rates do not stay at any one level forever. Land does not appreciate in a straight line forever. At some point, the environment shifts, and what matters is not how much you built during the good years. It is how much of what you built you can hold during the difficult ones. Earl Hendricks held it. He held it by making a decision in April 1981 that most people around him thought was a mistake, and by holding that decision through 2 years of watching his neighbors outperform him, and by keeping his fixed costs low when low fixed costs were not glamorous, and by maintaining liquidity when liquidity had no visible return. He died in 2003, owning 680 acres of Iowa ground, debt-free. The county line parcel was part of it. There is no moral decoration I want to add to that. The story doesn't need it. If you're farming, or running a business, or carrying debt of any kind, the question this story asks is not dramatic. It's simple. You can write it on a piece of paper and look at it plainly. What are your fixed costs? What does your operation require to survive, not thrive, survive, if revenue drops 30% and stays there for 3 years? Do you have the liquidity to wait through that scenario? Or have you structured your obligations around the assumption that the current environment is permanent? Those aren't rhetorical questions. They're accounting questions. The farms that failed in the 1980s farm crisis failed because the accounting answers were wrong, not because the farmers were wrong people or even wrong in their instincts about agriculture. They were caught in a structure that removed their options exactly when options were what they needed. Earl's refusal that Tuesday morning in April 1981 was not a prediction. He didn't know what was coming. He just didn't want to increase his exposure in a direction he couldn't control. That's all it was. And that was enough. If stories like this still matter to you, the kind that sit with agricultural finance and the quiet decisions that determine whether operations survive or don't, stay with me. There are more of them. None of them are simple. None of them are comfortable. They are, I hope, honest. That's the only thing I know how to offer.